Something extraordinary just happened in the gold market that almost nobody is talking about. While everyone's been distracted by stock market headlines and crypto volatility, a structural shift occurred that's going to change everything for precious metals investors. And I'm not being dramatic here. The data is undeniable. We're looking at a supply deficit that's unlike anything we've seen in modern market history. Not a temporary blip, not a seasonal adjustment, a fundamental imbalance between what the world needs and what the world can produce. And when you understand the mechanics of what's happening right now, you'll realize why some of the smartest money in the world is positioning aggressively in gold. Let me walk you through exactly what's unfolding, because the implications are massive. The gold market just recorded one of the largest supply deficits in decades. We're talking about demand outstripping supply by hundreds of tons. Now, you might be thinking, okay, supply and demand imbalances happen all the time. And you'd be right. But this isn't your typical market adjustment. This is a structural problem that's been building for years, and it's finally reaching a breaking point. Here's what makes this different. Gold mine production has been declining. Not just slowing down, actually declining. After decades of steady increases, global gold production peaked and started falling. The easy gold has been mined. The high-grade deposits are depleted. What's left requires more capital, more time, and more resources to extract. And here's the kicker. It takes 7 to 10 years to bring a new gold mine online. You can't just flip a switch and produce more gold when prices rise. Meanwhile, demand has exploded. Central banks are buying gold at the fastest pace in over 50 years. They're not buying a little bit here and there. They're accumulating thousands of tons. China's central bank has been buying every single month. The Reserve Bank of India is stacking gold. Poland, Singapore, Turkey, they're all loading up. These aren't speculative traders. These are the most conservative institutions in the world, and they're treating gold like it's the most important asset they can own right now. But it's not just central banks. Investment demand has surged. Gold ETFs are seeing massive inflows after years of outflows. Retail investors are waking up to what's happening with inflation, currency debasement, and geopolitical instability. And then you have jewelry demand, which never really went away, particularly in Asia where gold is deeply embedded in the culture. So you've got declining supply meeting surging demand. Economics 101 tells you what happens next. Prices rise. But here's where it gets really interesting. The price action we're seeing right now? This is just the beginning. Because the deficit isn't getting better, it's getting worse. Let me explain the mechanics of why this deficit is so significant. The gold market operates differently than most commodity markets. There's above-ground supply, which is all the gold that's ever been mined and still exists in some form. Jewelry, bars, coins, central bank reserves. That's about 200,000 tons. Then there's annual mine production, which adds roughly 3,000 tons per year to that total. In a normal market, that annual production is enough to meet incremental demand, but we're not in a normal market anymore. When demand exceeds annual production by a significant margin, the market has to pull from above-ground stocks. And that's exactly what's happening. Gold is being pulled out of vaults, out of ETFs, out of storage facilities to meet demand. The COMEX warehouses have seen dramatic drawdowns. Eligible gold stocks, the gold that's available for delivery, have been declining. The London Bullion Market Association vaults are seeing similar patterns. Physical gold is moving from west to east at an unprecedented rate. Now, here's the critical point. Unlike other commodities, gold doesn't get consumed, it gets hoarded. When a central bank buys gold, that gold is locked away in a vault, potentially for decades. When a wealthy family in Asia buys gold jewelry or bars, they're not planning to sell it. They're holding it as generational wealth. So every ounce that moves into strong hands is effectively removed from the available supply. The float, the amount of gold that's actually available for trading and delivery, is shrinking. And this is where the paper gold market becomes a problem. The vast majority of gold trading happens on paper. Futures contracts, ETFs, unallocated accounts. For every ounce of physical gold, there are multiple claims on that same ounce. It's a fractional reserve system, just like banking, and it works fine as long as everyone doesn't ask for physical delivery at the same time. But what happens when the deficit gets so large that people start questioning whether the paper gold is actually backed by real metal? We've seen this movie before. In the early 70s, the world was on a gold standard. The dollar was supposedly backed by gold at $35 an ounce. But the United States had printed far more dollars than it had gold to back them. When foreign governments started asking for their gold back, the system collapsed. Nixon closed the gold window, the dollar was devalued, and gold went from $35 to over $800 within a decade. We're seeing echoes of that dynamic right now. The paper gold market is massive, the physical gold market is relatively small, and the deficit is exposing the gap between the two. When you have more claims on gold than actual gold available, something has to give. Either the price rises dramatically to ration the available supply, or the paper market loses credibility and people demand physical delivery, which accelerates the squeeze. Let me give you a specific example of how this plays out. In the early 2000s, there was a similar dynamic in the silver market. A massive short position had built up on the COMEX. Traders were betting that silver prices would fall, so they sold futures contracts, promising to deliver silver at a future date. But they didn't actually have the silver. They were naked short. As long as prices fell or stayed flat, they could cover their positions at a profit. But then something changed. Demand for physical silver surged. Industrial users needed it. Investors wanted it. And suddenly there wasn't enough silver available to meet all the delivery requests. The shorts were trapped. They had promised to deliver silver they didn't have, and the price started rising. The more it rose, the more they lost, and the more desperate they became to cover their positions. This created a feedback loop. Rising prices forced short covering, which pushed prices even higher, which forced more short covering. Silver went from under $5 an ounce to nearly $50 in just a few years. The people who understood the supply deficit and positioned early made fortunes. Now, I'm not saying gold is going to 10 times its current price overnight, but the structural setup is remarkably similar. You have a deficit. You have a large paper market with questionable backing. You have strong hands accumulating physical metal. And you have a catalyst, which is the growing awareness that the financial system is more fragile than most people realize. Think about what's happened over the past few years. We've seen bank failures. We've seen currency crises in multiple countries. We've seen inflation rates that were supposed to be impossible in developed economies. We've seen central banks print trillions of dollars, euros, yen, trying to hold the system together. And through all of this, gold has been quietly rising, making new all-time highs in multiple currencies. But here's what most people miss. Gold isn't rising because of speculation. It's rising because of fundamentals. The deficit is real. The demand is real. The supply constraints are real. And the longer this continues, the more severe the imbalance becomes. Let me paint a picture of what this means for different types of investors. If you're someone who's been sitting on cash, watching your purchasing power erode, this deficit is a warning sign. Cash is a melting ice cube in an inflationary environment. The deficit in gold is telling you that smart money is moving out of paper assets and into hard assets. They're not waiting for permission. They're not waiting for confirmation. They're acting now. If you're someone who's heavily invested in stocks and bonds, this deficit is a diversification signal. Traditional portfolios are built on the assumption that stocks and bonds will move in opposite directions, providing balance. But what happens when both stocks and bonds fall together like we saw recently? Gold is the asset that tends to rise when confidence in the financial system falls. It's insurance. And the deficit is telling you that insurance is getting more expensive because more people are trying to buy it. If you're someone thinking about retirement, this deficit is particularly relevant. Because the biggest risk you face isn't market volatility. It's the permanent loss of purchasing power. If you retire with $1 million, but that $1 million buys half of what it used to, you haven't preserved your wealth. You've lost it. Gold has been the ultimate store of value for thousands of years precisely because it can't be printed, it can't be devalued by government policy, and it maintains its purchasing power across generations. Quick aside here, if you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description below. Covers how to get physical gold into your retirement account without tax penalties, how the process works, what the fees are, all of that. Worth checking out if that's relevant to your situation. No pressure, just information. Anyway, back to the deficit and what it means going forward. The supply side of this equation isn't improving anytime soon. Gold mining is a capital-intensive, time-intensive business. Even if gold prices double from here, it would take years for new production to come online. And that's assuming companies can even get permits, secure financing, and navigate increasingly complex environmental and social regulations. The reality is that gold production is likely to continue declining or at best stay flat for the foreseeable future. On the demand side, Every trend is pointing towards sustained or increasing demand. Central banks aren't going to stop buying. They're diversifying away from dollar-denominated assets. They're preparing for a multipolar world where the dollar isn't the only reserve currency. They're building gold reserves as a foundation for that transition. And once a central bank starts buying gold, they rarely stop. It becomes part of their strategic reserves. Investment demand is also likely to increase. As more people wake up to the reality of inflation, currency debasement, and financial system fragility, they're going to look for alternatives. Gold is the obvious choice. It's liquid. It's recognized globally. It has no counterparty risk. You don't need to trust a government or a corporation or a bank. You just need to hold the physical metal. And then there's the wild card: industrial demand. Gold isn't just a monetary metal. It's used in electronics, in medical devices, in aerospace applications. As technology advances, industrial uses for gold are expanding. It's not a huge percentage of total demand yet, but it's growing. And in a deficit market, every incremental source of demand matters. Now let's talk about what happens when a deficit market meets a price discovery event, because that's what we're potentially looking at here. For years, gold prices have been influenced heavily by the paper market: futures trading, algorithmic trading, central bank interventions. The price you see quoted isn't necessarily reflecting the true supply and demand for physical metal. It's reflecting the supply and demand for paper contracts. But when a deficit becomes severe enough, the paper market loses its ability to set prices. Physical metal becomes scarce. Premiums over spot price start rising. Delivery delays increase. And eventually, buyers are willing to pay whatever it takes to secure physical gold. That's when you get a price discovery event. The paper price and the physical price diverge. And the physical price is the one that matters. We've seen glimpses of this already. During the chaos of recent years, there were times when you couldn't buy physical gold at spot price. Dealers were sold out. Premiums were 20, 30, even 40% over spot. Mints couldn't keep up with demand. That was a temporary dislocation. But it showed what can happen when physical demand surges and supply is constrained. Now imagine that happening on a sustained basis. Imagine a scenario where central banks are competing with institutional investors who are competing with retail buyers, all trying to secure physical gold in a market where annual production can't meet demand. The price would have to rise significantly to ration the available supply. And once it starts rising, it creates its own momentum. Higher prices attract more attention creates more demand pushes prices higher. It's a reflexive loop. This is why some analysts are talking about gold going to $3,000, $5,000, even $10,000 an ounce. Not because of speculation, because of mathematics. If the deficit continues, if demand keeps exceeding supply, the price has to adjust. There's no other way to balance the market. And here's the thing that keeps me up at night. The deficit we're seeing now is happening during a period of relative calm. Yes, there's inflation. Yes, there's geopolitical tension, but we're not in a full-blown financial crisis. We're not in a currency collapse. We're not in a war between major powers. What happens to gold demand if any of those scenarios materialize? What happens if confidence in the dollar or the euro or the yen really breaks down? What happens if we see a sovereign debt crisis in a major economy? The deficit would explode, and the price would have to rise exponentially to clear the market. This is why smart money is positioning now. They're not waiting for the crisis. They're preparing for it. They're buying gold while it's still available at reasonable prices. They're building positions before the crowd realizes what's happening. Let me give you another historical parallel. In the late 1970s, gold went from around $100 an ounce to over $800 in just a few years. Why? Because inflation was out of control. Because confidence in the dollar was collapsing. Because people were desperate to preserve their wealth. And because there was a supply deficit. Mine production couldn't keep up with demand. The price had to rise to ration the available supply. But here's what's different this time. In the 70s, gold was coming off a period where it had been fixed at $35 for decades. It was massively undervalued. The move to $800 was a revaluation, a catch-up to reflect its true worth. Today, gold has already had a significant run. It's made new all-time highs. So some people look at the current price and think, it's already expensive, I missed it. But that's the wrong way to think about it. Gold isn't expensive or cheap based on its nominal price. It's expensive or cheap based on its relationship to other assets, to money supply, to debt levels, to real interest rates. And by those measures, gold is still historically undervalued. The money supply has exploded. Debt levels are at all-time highs. Real interest rates are negative or barely positive. In that environment, gold should be much higher than it is. The deficit is the catalyst that's going to force that revaluation. And here's another factor that's often overlooked. The gold market is tiny compared to other financial markets. The entire above-ground supply of gold is worth around $15 trillion. That sounds like a lot until you compare it to global stock markets, which are worth over $100 trillion, or global bond markets, which are worth over $130 trillion, or global real estate, which is worth hundreds of trillions. If even a small percentage of capital flows out of those markets and into gold, the impact on gold prices would be enormous. We're talking about a market that's too small to absorb large institutional flows without significant price appreciation. And that's exactly what's starting to happen. Pension funds, sovereign wealth funds, family offices, they're all starting to allocate to gold. Not huge percentages, but enough to matter in a market this size. The deficit is the signal that this reallocation is already underway. It's not theoretical. It's not something that might happen in the future. It's happening right now. The demand is exceeding supply. The physical metal is moving into strong hands. And the price is adjusting, albeit more slowly than the fundamentals would suggest. So, what should you do with this information? First, understand that this isn't about timing the market perfectly. It's about recognizing a structural shift and positioning accordingly. The deficit isn't going away. The supply constraints aren't going away. The demand drivers aren't going away. This is a multi-year trend, not a short-term trade. Second, think about physical gold, not just paper gold. ETFs have their place, but they're not the same as holding the actual metal. In a real crisis, in a scenario where the financial system is under stress, you want to own assets that have no counterparty risk. Physical gold in your possession or in secure storage is the ultimate form of financial insurance. Third, don't wait for confirmation. By the time everyone agrees that gold is the place to be, the price will already reflect that consensus. The opportunity is now, while the deficit is still being ignored by mainstream investors. While people are still debating whether inflation is transitory. While central banks are still pretending they have everything under control. The gold market is sending a clear signal. There's a massive deficit. Supply can't meet demand. And the imbalance is getting worse, not better. This is the kind of setup that creates generational wealth transfer. The people who recognize it early and act decisively are the ones who benefit. The people who wait for certainty, who wait for permission, who wait for the crowd to validate their decision. They're the ones who end up buying at much higher prices or missing the move entirely. History is full of examples where supply deficits in critical commodities led to explosive price moves. Oil in the 70s, copper in the 2000s, lithium more recently. Gold is no different. It's a finite resource. It can't be created out of thin air. And when demand exceeds supply in a sustained way, the price has to rise. It's not a matter of if. It's a matter of how much and how fast. The deficit we're seeing now is the early stage of what could be a historic move in gold prices. The fundamentals are aligned. The technical setup is strong. The sentiment is still skeptical enough that there's room to run. And the macro environment, with inflation, currency debasement, geopolitical instability, all of it supports higher gold prices. This isn't about fear-mongering. This isn't about predicting the end of the world. This is about recognizing reality. The gold market is in deficit. That deficit is structural, not cyclical. And the implications for prices are significant. Whether you're an investor looking to preserve wealth, a trader looking for opportunity, or someone just trying to understand what's happening in the financial system, this deficit is something you need to pay attention to. The smart money is already positioned. Central banks are buying. Institutional investors are allocating. Wealthy families are accumulating. They're not doing this because they're pessimistic. They're doing it because they're realistic. They understand that the financial system is built on a foundation of debt and currency creation. They understand that gold is the asset that maintains its value when that foundation cracks. The deficit is the proof that this understanding is spreading. More people are waking up. More capital is flowing into gold. And the supply simply isn't there to meet that demand without a significant price adjustment. This is the opportunity. This is the moment where positioning in gold goes from being a nice-to-have to being essential, because once the deficit becomes obvious to everyone, once the price starts moving in earnest, the opportunity to buy at reasonable levels will be gone. So prepare accordingly. Understand what's happening. Recognize the significance of this supply deficit, and make decisions that protect your wealth and position you for what's coming, because the gold market is telling us something important, and the people who listen are going to be very glad they did.